Welcome to this session where we discuss monetary tools. Monetary tools refer to instruments or measures taken by the central bank in order to regulate activities of commercial banks, regulate credit creation in the country, and generally influence lending activities by commercial banks. These tools of monetary policy include: 1. Compulsory deposit requirements. Compulsory deposit requirements. This is whereby the central bank requires commercial banks to keep certain money with the central bank. The commercial banks open accounts where they deposit this money, being a percentage that is given by central bank and stay frozen in the accounts held at the central bank. From time to time, the central bank may increase the percentage or reduce the percentage of the compulsory deposit requirement as may be desired in order to increase the volume of money circulating or reduce the volume of money circulating in the country. The second tool is the cash ratio. And this is where commercial banks are required to hold a certain percentage or proportion of the total deposits made to them by customers in form of cash, so that they can take care of customers who may need cash to transact. It can also be referred to as liquidity ratio. Liquidity ratio is whereby commercial banks hold some assets that can be easily transformed into cash for the purpose similar to what we have said about the cash ratio. The third monetary policy is bank rate. This is the rate at which the central bank gives loans to commercial banks during times of crisis or financial distress, as the central bank serves as a lender of last resort for the commercial banks. So, this rate influences the base rate at which commercial banks lend to members of public. Increasing the bank rate makes loans expensive and contracts credit creation, while reducing the bank rate makes loans attractive and therefore encourage borrowing and more circulation of money in the economy. At number 4, we have selective credit control. And this is whereby commercial banks are given instructions by the central bank on the sectors of the economy, particular sectors onto which they need to lend only and leave the other sectors. This depends on the policies of the government of the day. For instance, the government may aim to encourage lending for manufacturing sector, the agricultural sector, or service industries like tourism, hotel and hospitality, among others. At number 5, we have moral suasion, or moral persuasion. Moral persuasion. And this is a situation whereby the central bank appeals or requests commercial banks to increase lending or reduce lending activities without giving directives or specific instructions on what to do. They appeal onto the moral values of the banks to act in favor of the economy of the country as may be desired, to increase the volume of lending so that we can increase economic activities, or to reduce lending where it is desirable to curb inflation. So sometimes we might look at tools of monetary policy meant to increase lending and therefore increase the volume of money circulating in the country. For number one, we need to lower the compulsory deposit requirement so that money that was held by the central bank is released to commercial banks for lending. Number two, we also lower the cash ratio requirement and therefore require the commercial banks to hold comparatively lower percentage of their total deposits in form of cash so that more money is available for lending. The third measure is to reduce the bank rate so that credit becomes attractive to members of public. They borrow more loans and have more money in circulation. The fourth step is to increase on the sectors that would be led to through selective credit control. And lastly, we can appeal to the commercial banks to increase lending through moral suasion. On the other hand, some measures may be desirable to decrease lending or credit creation by commercial banks and by extension reduce the volume of money circulating in the country as may be desirable, especially during times of inflation. One way to do that is to increase the compulsory deposit requirement, to increase the cash ratio requirement or increase the liquidity ratio requirement. Number three is to increase the bank rate so that the central bank lends at comparatively higher prices to retail banks, and by extension, the retail banks would equally increase their lending rate to customers and make credit lesser attractive. We can also employ selective credit control as well as moral suasion, whereby we appeal and request commercial banks to cut on lending. Thank you for being attentive. Hope you followed us. Like our video and subscribe to our YouTube channel at Kelvin Kaburu for more interaction and more of such educative and informative videos. Goodbye for now.